For decades, American assets have pretty much been the cornerstone of any global investment portfolio. It was just a given. But has something fundamentally changed? Let's dive in and really rethink what it means to invest in the US today. So, what kicked this whole conversation off? Well, you saw the headlines. The US government just shut down again. Now, this isn't the first time, not by a long shot, but it's the kind of thing that always gets people talking and raises some really important questions for investors all over the world. And it really boils down to one critical question, especially if you're watching from outside the US. Should you be worried? Well, the answer isn't a simple yes or no. It's actually a lot more complicated than you might think, because the shutdown itself, that might not even be the real story here. So, to understand why, we've got to start with the basics. Section 1, the US government shutdown. Let's talk about what it is and, just as importantly, what it isn't. So, when a shutdown happens, a few things kick in. Non-essential government offices, they just close their doors. A ton of federal employees get sent home without pay. And this can even stop key economic data from being released, which, creates a lot of uncertainty for the markets. But here's the thing. There's a new threat this time around. There's been talk of using a shutdown as a way to permanently fire federal employees, which could make the economic hit way, way worse than what we've seen before. Now, this next point is absolutely crucial to understand. We have to draw a bright line between a government shutdown and a debt ceiling crisis. A shutdown, that just pauses government functions. It's a drag on the economy for sure. But a debt ceiling crisis, that's about the government not being able to borrow more money to pay its existing bills. That carries the risk of a full-blown default on US government bonds, which is a much, much scarier world for investors. And honestly, this distinction is exactly why, in the past, markets have kind of just shrugged off government shutdowns. The direct impact is usually pretty minor. And this is a huge but. Here's the twist. If this were just a one-off event, we wouldn't be having this conversation. As one analyst put it, quote, "It's just the latest symptom in a concerning sequence, and that sequence is what we really need to unpack." Okay, let's move on to section 2, which we're calling a symptom, not the disease. This is where we get into why this time really does feel different. You see, this shutdown isn't happening in a vacuum. It's part of a much bigger pattern of, unpredictability. We've seen these dramatic tariffs slapped on foreign partners, threats to tax foreign investors, back and forth on major military commitments, and huge shifts in immigration and worker policies. Each one of these on its own adds a layer of uncertainty. So the problem isn't just one policy or one event. When you step back, the real issue is that America has become less predictable. Its political and financial systems are now way more reliant on a single point of failure, the actions of the president. So what on earth does this mean for your portfolio? That brings us to Section 3, reevaluating America's risk profile. We're going to look at 3 hidden dangers you might not be thinking about. First up, let's talk about U.S. government bonds. For decades, these were called the risk-free asset. Literally the safest place on earth to park your money. But the reality has changed. There is now a non-zero, politically driven risk of default. It's not zero anymore. And this isn't just a theory, right? Look at this timeline. In 2011, then again in 2013, and just recently in 2023, the US came dangerously close to a default, all because of political fights over that debt ceiling. Now, each time they pulled back from the brink, but the fact that they're willing to even get that close to the edge, that's what's changing the whole risk calculation. And hey, you don't have to take my word for it. The major credit rating agencies, we're talking S&P, Fitch, and Moody's, they've all taken notice. Every single one of them has downgraded their rating of US debt in recent years. That's a huge signal that the risk-free label, it just doesn't quite fit anymore. Okay, let's talk about risk number 2, US stocks. Historically, the US has been the prime example of a developed market, right? Defined by the rule of law, transparency, all that good stuff. But now it's starting to show some characteristics of an emerging market, where the decisions of a single leader or one party can just massively impact entire industries and your profits. That political risk is a much bigger piece of the puzzle now. And this brings us right to the third risk, a serious lack of diversification. Now, on one level, this is something we've been talking about for years. The S&P 500, for instance, has become incredibly top-heavy. Just the top 10 tech stocks, they now make up about 30% of the entire index. But hold on, there's a second, much deeper diversification risk that's kind of hiding in plain sight. This is a systemic problem, and it affects every single stock in that index, no matter how big or small. And that problem is systemic risk. In this context, what we mean is the risk that all 500 of those companies, doesn't matter what industry they're in, are all directly exposed to the unpredictable decisions of one person. Suddenly, your diversification across different sectors, it's a lot less effective when one political decision can wax them all at the same time. Okay, so we've identified the risks. It might sound a little bleak. So what do we actually do about it? Let's turn to Section 4, a new playbook for investors, and talk about how to navigate this less predictable America. It really comes down to a pretty simple 3-step playbook. First, stay aware. This is more than just reading headlines. It's about fundamentally recognizing that the US just isn't the risk-free anchor it once was. Second, stay prepared. This means stress testing your own finances. Could you handle a sudden politically driven market drop? If not, building up a safety cushion is absolutely key. And third, stay prudent. This is the active part. It means taking a hard look at your portfolio and seriously considering rebalancing to reduce that concentrated US-specific risk. But it's so important to understand the why behind that last point. Rebalancing, as this quote puts it, is about reducing America-specific risk. It is not a guarantee of more profit. The US market might keep soaring, who knows? The goal here is to build resilience, not to try and time the market. So, look, if you remember just one thing from this whole explainer, let it be this. At the end of the day, the key takeaway is to think about how you can reduce the direct impact of US government dysfunction on your investments. And that leaves us with one final question for you to really think about. This isn't about abandoning the US market, not at all. It's about seeing it with fresh eyes. Is your portfolio truly diversified for a less predictable America?